G'day everyone, and welcome to today's episode where we're going to take you through the 5 key elements when looking at your home loan to refinance. Now, refinancing is something that occurs a lot in Australia just because of the way a bank is structured. I always tell clients it's an unfortunate situation that the way the bank operates is similar to electricity and insurance. Loyalty doesn't pay. And in this business, where mortgage could be your highest cost in your budget, you really have to value refinancing or renegotiating with your existing bank. So I've just got 5 key things for you to think about because there's a lot of different reasons why you refinance, and it's important to narrow down what you're trying to achieve. So let's get into it. So the first thing to decide when looking to refinance is to understand what are you actually changing in your loan. The first item you can change is called the term. Generally, in Australia, your mortgage is a 30-year loan. Now, as the years go by, your loan goes from 30 to 29 to 28, and it continues to reduce down. And when refinancing, you have the option to re-extend that out to 30 years. What that does is, it ensures that one, you might have a lower repayment because you're re-extending your loan, but on the flip side, you're repaying interest, you're almost restarting. We often suggest rarely to extend your term out because it's just going to add to the overall interest cost. That only occurs when we suggest if you have an investment property and you're looking for tax deductions and your life is a little bit more complex. But if you're a general homeowner, we suggest do not change your term. If you bought your house 5 years ago, you want it to pay off in 30 years from then. And if you keep re-extending it, it pushes the time out further and further and further. So the first thing when you think about refinancing, what am I doing with my term? Number 2, the next thing to think about is what am I doing with my repayment type? There are 2 types of repayment types. There's interest only and principal and interest. Principal and interest is when you're paying the bank its interest and you're paying the loan off. So your loan decreases over your time. And there's a point somewhere in the future where you have no loan and a house for free. Not for free, you paid for it, but a house that has no debt on it. Interest only is you're just paying the interest, and then one time in the future, you'll have to accelerate the repayment. When refinancing, you have the choice of either or. Again, it's important to know the benefits of either of them. Interest only means you only pay interest, so your monthly outgoings might be less. Principal means you're aggressively paying the loan down, so the future benefit is that you'll have a lower loan over a long time. You have the choice to choose these depending on the type, investment, not investment, where your life is right now. You get those options. So the second most important thing is repayment type. What are you choosing and what are you going to adjust in this refinance? Number 3 is now we're talking about the rate type. There are 2 types of rates, variable rates and fixed rates. Again, when you refinance, this question comes up for grab. What is your rate type? Variable means you're going up and down with the market. Fixed means you have a fixed interest cost for a certain period of time, from 1 to 10 years in Australia. Most banks sit between 1 and 5 years. This is all about certainty. Do I want to keep my variable or do I want certainty? When you refinance, you have the option to choose this. So number 3 is, what am I doing with the rate type? Number 4, obviously one of the most important things, what is actually my interest rate? Refinance is about optimizing your home loan. Like I said, it could be term, it could be rate type, it could be repayment type, but ultimately you want to pay lower interest to the bank. That will save you the most over your time and allow you to have more cash to go invest or more cash to accelerate the home loan down. Ensure that the repayment is set to a rate that's better than what you're on. We want to optimize and improve, not go backwards. But in some circumstances, you might go backwards. You might pay a higher rate to go interest only. You might pay a higher rate to extend your term out. All of this is really important to ascertain why you're doing these things and what is the benefit you are seeking to achieve. For the majority of Australians out there, you're just trying to get a better rate. So focus on the rate. The last one. Banks have a lovely way of stinging you with fees in and out. There's government fees, discharge fees, settlement fees, annual fees. Ensure you know the costs of the fees to refinance. It's generally not free to refinance. There are some instances, what we've seen recently, there are cashbacks and rebates that can incorporate what we call a no-fee refinance, but ensure you know what you're paying for and what you're getting. The cost to refinance can actually negate the interest saving. So if you don't factor that in, it can really be a pointless exercise. And amazing. They're the 5 tips that I think you got to think about. I'll summarize them very quickly. What is your term? What's your repayment type? What's your rate type? What's the actual rate? And what are the costs? Refinancing continuously can provide a lot of benefit, but it has to fit with your goals. Reach out to someone like us, like a mortgage broker, and we'd love to help. Thanks again. Bye.